One of the big challenges that you will face in picking a mutual fund is the amount of choice you have. With over 40 AMCs, more than 1,000 funds, and over 2,000 schemes, you are truly spoiled for choice. Do you just go for the highest rated fund, or do you blindly invest in a fund that has generated the highest return last year? How do you choose the winning mutual fund and create the winning mutual fund portfolio? We will find out in this video. And we do such financial education videos every week, so do subscribe if you want to grow your wealth. First, let's start with the basics. To start investing, you need to find a fund that is in sync with your investment goals. And you can do that by answering these 3 questions. Number 1, how much risk are you willing to take? Number 2, what is your investment time horizon? And number 3, what is your investment objective? Let's break this down. Number 1, risk profile. See, if you have aquaphobia, the fear of water, then you will not go for scuba diving, hai na? Similarly, if you have low tolerance for risk, then you should stick to funds who have lower risk profile. We are mainly going to focus on the equity mutual funds in this video, so let's check out their risk profile. Large caps are usually the least risky among the equity mutual funds. Number 2, time horizon. You should invest in debt funds if your investment time horizon is a short term of 1 to 3 years. If you can stay invested for 3 to 5 years, you can go for hybrid funds, which invest a portion in debt funds and the balance in equity funds. Go for equity funds if you can invest for more than 5 years. Small or mid-cap funds, your time horizon needs to be around 7 years or more. And number 3, investment objective. See, there is no one-size-fits-all portfolio in finance. The fund that may be right for you may not be right for someone else. You may have different investment objectives. Some of you may be looking for regular cash flow every month. Some of you may be looking for capital appreciation. So, while choosing a mutual fund, it is necessary to identify the financial goals that you want to achieve. After you have answered these 3 crucial questions, you need to get into some numbers. So let's look at the quantitative factors to shortlist the mutual funds. Number 1, past performance. Every mutual fund will tell you that past performance is not a guarantee of the future results. But as an investor, mostly we invest based on only this factor. While it's important to analyze the past performance, you also need to ensure that you do not invest solely based on this factor. So how do you analyze the fund's past performance? Well, there are 3 ways to do it. A, you need to compare the fund's result against its peers. B, compare against the benchmark. And C, compare the performance across the market cycles. Let's see each of these. Performance against the peers. So, while you are comparing the performance against the peers, you need to make sure that you are comparing within the same category and subcategory. If it cannot beat its peers consistently, then the fund is not worth investing in. Also, make sure that you are comparing, for example, a large fund with another large cap fund. Do not compare apples to oranges and arrive at a wrong conclusion. Performance against benchmark. Every mutual fund has a benchmark against which it checks its performance. If an actively managed fund cannot beat the benchmark, then you are better off investing in an index fund whose returns are almost always in line with the benchmark. Hannah, what is the point of active fund management? Now, how do you check this performance against the benchmark? There are 2 ways to do it. You need to check the alpha and the beta. Alpha. A positive alpha of 1% means that the fund has outperformed its benchmark by 1, while a negative alpha of -1 means that the fund has produced 1% lower return than the benchmark. So you should always try to invest in funds that have higher alpha. 7% benchmark return, 9% fund return means 2% alpha. And beta. Beta measures volatility in relation to the benchmark. So what does that mean? A beta of 1 means that the fund's NAV will move in line with the market. Beta greater than 1 means that fund is more risky than the market. So if the market goes up, the fund will go up more. And if the market goes down, the fund will go down more. A beta of less than 1 means that the fund is less risky than the market. So it's better to have a higher beta in a rising market and a lower beta in a falling market. Performance across market cycles. A good mutual fund should be able to generate good return for its investors consistently over a long period of time. A good fund should provide consistent return over bull, bear and sideways market. Let's see the performance of Mirae Asset emerging blue chip fund across different bull and bear cycles. you can see that the fund has performed well across bull and bear cycles, and it has managed to lower the downside risk as well. So do study the fund's performance across bull and bear cycles. Number 2, diversification. You need to check if the fund is overexposed to a few stocks, or if the corpus is spread evenly across stocks from different sectors. The whole point of investing in mutual funds and not stocks is to get the benefit of diversification. So when you select a mutual fund, ensure that not more than 50 to 55% of the corpus is invested in the top 10 stocks of the fund. Number 3, investment costs. What are the costs involved in investing in a mutual fund? Well, there are two major costs borne by the investors: the expense ratio and the exit load. Expense ratio is the fees charged by the fund for the management, administration, distribution, and promotion of a mutual fund. All expenses incurred in managing a fund is included in this number. This expense actually cannot be more than 2.25% of the total fund assets because SEBI has capped it at that level. Direct plans usually have lower expense ratio compared to the regular plans because the fund house does not pay any commission in the distribution of direct plans. So remember, the lower the expense ratio, the higher the net return for the fund. Exit load. This is a penalty charged by the mutual funds if you prematurely exit from the mutual fund. And it varies across different schemes. So for example, for equity mutual funds, you will need to pay an exit load if you redeem before 1 year. Liquid funds may have a threshold limit of 7 days. Also, do remember that some funds like HDFC Credit Risk Fund have an exit load period of 540 days. And do remember that exit load is different from the lock-in period. You can redeem an equity fund before 1 year by paying the exit load. But if the fund has a lock-in period, like the ELSS funds, then there is no option to redeem before its lock-in period ends. I hope you now have a basic understanding of what factors you should consider before investing in a mutual fund. There are some ratios as well that you can look at, which we'll see in our next video. Ensure that you are monitoring your investments on a regular basis. Invest and forget is not the best investment strategy. When you get the fund fact sheet every month, do check the fund manager's commentary, the return, the variance in the return, and other factors. This can give you a lot of insight. If you have any comment or feedback about this video or the channel, do let me know in the comment section. If you like this video, press the like button, hit subscribe and click the bell icon. Wrapping it up, this Paritosh signing off.